Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. Some 47 lakh central government employees and 53 lakh pensioners will take away salary increases and arrears as the 7th Pay Commission goes into force with effect from January 1st, 2016. Now, the much-awaited move will cost the government an additional 102,000 crore rupees if all the recommendations are implemented. Now, there are two key questions here. First, what does this pay hike do to the economy, given that spending power in the hands of millions of government employees or pensioners will increase? And second, how does this impact the government's finances at the centre and state levels? To discuss this, I'm joined by Sudip Bandyopadhyay, market expert and chairman of Indie Trade Capital, and DK Joshi, chief economist at CRISIL. Sudip, let me begin with you. So what's the sense, both from a market's point of view, both from an expenditure, potential impact positively on companies' bottom lines?
Well, I think it's a fantastic news for the economy. We have been kind of struggling because private spending, private consumption and private investment was not as what we were expecting. The government has been spending and trying to kind of push up the growth rate, but it's like trying to clap with one hand. The private was absent. Now this injection of liquidity into the hands of, as you rightly said, millions of people will definitely get reflected in the economy, maybe with a bit of a lag, but it's definitely going to come back to the economy. So yes, you will see lots of sectors benefiting, people coming and spending, maybe something for consumption, maybe something for building for the future. So you will have housing, you will have a whole lot of sectors benefiting out of this. Overall, we think economy will definitely benefit. By what percentage the growth will be pushed up, it's difficult to estimate at this stage, but definitely there will be a positive impact on the growth. We also heard from the finance ministry that this has already been factored in the budget. So I suppose there will be too much of a negative impact.
Okay, great. DK, your sense of what this means, and more importantly, if you were to compare with previous pay commission hikes, what is the impact, whether it's immediate or with a lag, on the economy from a spending point of view, and of course on the balance sheet itself?
Well, I think the previous pay commissions had a lot of areas built into them because they were implemented with a lag. So this time it's being implemented with a delay of only 6 months. So the area component is not that high. So from an economy perspective, the impact will be muted compared to the previous pay commissions. But I think let me get to how it's going to play out for us. See, when people get money, they'll either consume, they'll save, and they'll also have to pay taxes. So I think looking at the aggregate amount kind of can be misleading because part of it will be saved and part will go into taxes. But yeah, I think I do agree with what Sudip was saying, that it's a positive for consumption at this juncture. I think with Brexit, the risks from the global side are increasing. So you have to look inwards to growth. And I think the consumption, once it gets a boost, or rather a support, I would say. I think one from the pay commission hike and the second from the rural economy. I think if both of them come together, I think the private consumption will be on a stronger footing, and that will create conditions for private investment to take place, I think, which is now shying away as of now. So I think our expectation is as consumption demand goes up, the capacity utilization will start improving, and I think the private sector will also come up with their investment plans probably towards the end of this fiscal year.
Right. So any sense of how that could translate? You talked about capacity levels going up. Is there any area that you see benefiting immediately or in the foreseeable future?
Well, I think it's typically the consumer demand benefits the durables as well as the non-durables, and the auto sector immediately comes to mind. I think that's where since this time the hike is not that great, or the area component is not that great, I think, but still it's definitely going to be good for smaller cars, two-wheelers, etc. And then other appliances, durable goods, etc. I think these are the things which typically get bought when you get a sudden increment to your income.
Okay, Sudip, your sense on how the markets have responded to this? To some extent, this has been priced in, perhaps. And of course, we've had other problems, including Brexit, which have shaken the markets. But do you see this overall impacting positively, and in what way?
Absolutely, Govind. I think you're right. Brexit was a huge shock for the markets, but look how the markets had behaved over the last few days. And definitely one of the contributing factors to for the markets to turn positive has been this pay commission recommendation and implementation of that. So obviously people are expecting, as DK was mentioning, certain sectors to benefit. I will probably add to what DK was saying, the housing, the housing space. This space has been struggling for quite some time, the real estate and the housing sector. So I think there will be a boost to that sector as well, because people look at, either buying a flat or, taking a housing loan and things like that. The capacity to spend is increasing. So they will definitely look at housing. They will look at consumer durables. They will look at two-wheelers and four-wheelers. So I think whole lot of sectors will benefit, and I think to an extent that's reflected. But as things actually translate on ground, I think you will see an even bigger reflection in the corporate numbers. The companies which are going to benefit, their numbers will start coming, and overall there will be a virtuous cycle. I think one thing which we were lacking for last 2 years was the private spending, and I think that's going to come. We are expecting.
But is that also because of the diminishing of propensity to spend, or is it? Would you say it was actually the physical presence of money or arrears, as this case may be?
I would tend to think that yes, there was a propensity issue as well. But look, when you put 100,000 crore in the hands of the people, they will definitely spend. I mean, it is going to come in some form or the other. They may just spend for consumption, or they may spend for building assets. So I'm saying economy eventually will benefit. Money circulation will increase. Corporate performances will start improving. So I think it's a very positive thing. The only worry is whether inflation will go up, whether deficit will move up. But I think the finance ministry is assuring that this has all been factored in, and I don't think there is any need to worry on this.
Right. So DK, do you think what are the likelihood that this could be inflationary? A question that's of course being asked by many people.
Well, I think typically pay commissions do push up prices, but I think this time around the dynamics are slightly different. One, the quantum is not that great, as I just mentioned earlier. And then second, I think the Brexit has a positive spillover to inflation. I mean, I would say that the commodity and crude prices will now stay lower for longer, and I think that's good news on the inflation front. And then you have monsoons playing out favorably after 2 years of near drought, and I think that's going to help control food inflation. So while this driver from the demand side will push inflation up, there are some other dampeners which also will come into play. So what kind of inflation you end up with will be an interplay of these, and I think so we need to closely monitor what's happening to global commodity crude prices, and also how the monsoon proceeds. Now the other thing on the consumption side I just wanted to add was that until now we've only been talking about the central government. There's a state government also once we bring that into picture, I think you see a much larger consumption impact, because the payouts from the state governments, if it is fully implemented, will be at least 2 times of the central government, and which is going to happen over a period of 1 to 1.5 years. So it's going to lead to a sustainable pickup in consumption demand, depending on how the states implement this.
So you're saying another 2 lakh crores into the system thanks to state governments falling in line. Now, I was looking at some of the reports. Gujarat, for instance, says it's going to add 6,000 crores to its 28,000 crore bill for salaries and pensions. Now, how many states can realistically afford this, and how likely is it to actually roll out in that fashion?
Well, I think there is a pressure from Uday bonds, etc., which will eventually, I think, are getting transferred from the state utilities to these state government balance sheets. But I think not all states are equal. I mean, some have better fiscal capability, others don't. So I think some will be in a position to implement it faster, and the others will trail. I mean, so I think it's going to be, so that's why I said eventually everybody is going to give some increase or the other, but I think it's going to continue over a period of 1 to 2 years.
You see that creating a problem or an asymmetry, DK? I mean, the fact that some states will be able to respond faster than the others?
I think that's how it typically happens. I mean, everybody doesn't implement it at the same go.
So, Sudip, if you were to now look ahead, I mean, casting a look at the markets as a whole, one is, do you see some of this now, if we are saying it could be 1 lakh crore, potentially going up to 3 lakh crore, coming back into financial markets in some way, or is it all going to go into, let's say, more physical consumption items?
No, definitely, Govind, something will come back to the financial market.
In the past, if that's been the case,
yeah. It will definitely be the case. You see, when people will get the money, there will be some amount of spending, whether it's buying a flat, buying a two-wheeler or an automobile, or maybe the consumer durables. But some amount of money definitely will be saved out of this, and that's a human thing, psychology. So the savings will definitely flow back into the financial market. How much of it will be in a bank fixed deposit or a postal savings and all that, and how much will actually flow back into the market, maybe via mutual fund route or some other insurance schemes, is a little difficult to predict at this stage. But knowing the nature of the people who is going to get this, government employees, by and large conservative, conservative. I would assume that most of the money, the part of being saved, will be in some kind of deposits with different banks or institutions. A small part of that may flow back into the market through the mutual fund route.
Right. So, DK, if you were to look at the components of what makes us feel good, or the feel good factor in an economy, assuming private spending or this element of private spending is one part, what else remains to be done?
Well, I think eventually for sustainability of the growth process, the investment cycle has to turn. And I think we know that overall investments to GDP ratio has been falling continuously for the last 5 years. And I think our belief is that this year it will kind of stabilize, because one, government has pumped in investments, and second, I think the private sector in few pockets will also start looking at investing. So I think from a sustainability perspective, or whatever feel good factor you get out of the pay commission, for it to sustain, eventually there has to be economic activity, and that can, I think, only come from revival of the investment cycle.
So, and if you look at what the government has been doing, so it's been pump priming in a way because of the increased spending on roads, railways, and now here with the pay commission putting money in the hands of government employees. So the government seems to be doing its bit. I mean, does it need to do more?
Well, I think it doesn't have the bandwidth to do more. I mean, see, while they are pushing money from in few segments, but overall, I think they're crimping, because the fiscal deficit as a percentage of GDP is coming down. So the fiscal policy as a tool for promoting growth is still restrictive. I mean, unless they expand the fiscal deficit, I think they can't give a big stimulus. So what government has done is they've chosen the sectors where the multiplier effects are higher, and which will raise the growth potential also at the same time, like building roads or railways. So I think they cannot give a cyclical push from the fiscal policy side. I think they can only do it by restructuring the expenditure a bit, which is what they're doing.
Sudip, last word and 30 seconds, wish list, what the government needs to do. I mean, more from a policy point of view.
Govind, I was waiting for you to ask me that question, because I think there is one thing which the government needs to do now. See, private sector, I'm not talking about individuals, private sector needs to come back and start investing in the economy, and which is not happening to the extent we would love to. And for that, I think the banking system needs to be put back on tracks. There are still a whole lot of uncertainties, recapitalization, merger of PSU banks. See, we want the banks to come back and start lending into the market, into the corporates, to the corporates, and that's still not happening. That part needs to be taken up by the government on a war footing, and the banks need to start functioning once again the way they are supposed to function.
Right. That's a good note to end on. Thank you so much, Sudip and DK. We need to go in for a break. Coming up on the other side, Brexit is still hanging like a sword over the Indian economy and markets. We find out exactly how and why. Stay with us. Welcome back to Policy Watch. Indian stock markets have reacted positively to a whole slew of domestic news developments, ranging from the 7th Pay Commission and more money in the pockets of millions of government employees to a strong monsoon in recent days. More importantly, the markets have shrugged off the entire impact of Brexit, or British referendum on leaving the European Union, which had caused the Bombay Stock Exchange Sensex to crash 1,000 points on a single day last week. Now, the Sensex has come back to the 27,000 mark, a level seen a day before the results of the referendum were announced. Moreover, the rupee has appreciated from 100 rupees to a pound to around 90 rupees a pound. So the question we are asking is Brexit out of the way now, or should we be still concerned about the negative news flow from Europe and Britain? And more importantly, are Indian markets and the economy showing greater resilience to global events? If so, how should that translate into a policy response? To discuss that, I'm joined by Ajay, Bagga, Chairman of OPC Asset Solutions, Dr. Brinda, Jagirdar, former Chief Economist of the State Bank of India, and Anindya, Banerje, Associate Vice President and Currency Analyst at Kotak Securities. Thank you all for joining us. Let me begin with you, Ajay. What's your sense? I mean, the market men were predicting 5 to 10% fall in coming days as the whole effect of Brexit would sink in, but that's not happened in India, nor has it happened internationally.
Yeah, I think a couple of things. One, on deeper analysis, it came out that Brexit will take time. It's not an immediate event. In fact, John Kerry yesterday made a statement there might not be a Brexit at all. So there seems to be some via media being found, and that gave the market some kind of hope. Second is the global liquidity. I think that remains the accommodative stance of the global central banks, which has meant that there's enough and more liquidity. We saw strong action from the Chinese central bank, from the BOE yesterday, the statements from Governor Carney was very clear that we'll cut rates as needed. I think that accommodative stance also has put a bottom under the markets. Third, I think India stays in a good sweet spot, and there was a Morgan Stanley report also out where they had ranked India, Indonesia, Philippines as the most attractive markets. Yesterday, Indonesia gave a 52-week high, and India followed very close to it. Of course, we are far from our March 2015 highs of 9,100, but the markets are discounting, one, that the GST gets passed, second, structural reforms will get really turbocharged. I think those are the two expectations, along with a good monsoon.
Okay, so I'll come to the structural reforms and GST in a moment. Brinda, what's your takeaway in terms of how Indian markets are reacting, and by any extension, is that applicable to the economy as well?
Remember the World Bank president who was visiting India, he just said that India is in a sweet spot, in a bright spot. So in a scenario when most countries are struggling to grow, I think India is growing at a good clip. So that itself is a very good thing for us. What is the impact of Brexit? If that is the question, I would say there is, let's say in the near term, our macro fundamentals are sound. So we have raved it very well, as our markets have shown. But going forward, let's not take it for granted. Let's not be complacent about growth. We need to continue, as Ajay just said, we need to have our reforms in place. Structural reforms should now, from here on, take on at a higher trajectory. And that is what will attract investment, and that is what will keep up the growth momentum.
Right. So, Anindya, I mean, two factors. One is, of course, what happened in Brexit itself and what happened in the European and British markets. But the fact that the pound has really depreciated against the rupee, and the Indian markets have also held back. How do you see this? I mean, if currency being a signal of sorts to the larger ecosystem?
The pound was one of the overvalued currencies. It needed a trigger, and this was a seismic shock. So we think this will make pound one of the most attractive currencies in the world over a period of time, which means it's great news for UK. So people who are thinking that Brexit will be Armageddon for UK, it's I don't think it's that simple, but it's bad news for Europe and others, because their currencies becomes that more expensive compared to UK.
Okay.
And as far as the spillover on the Indian markets go, over the near term, no, there is not much spillover except for that 24 hours or 48 hours of flutter we had. What we need to watch the channel is the Chinese yuan, because Europe, including UK, is the largest trading partner of China. If that entire region is going to face a global economic impact out of the Brexit, then it can spill over into the Chinese yuan. If the Chinese yuan starts to react, it will have a spillover into the rupee as well.
Right. Okay. So Ajay, you talked about liquidity as being a single important contributing factor, to which there are so many announcements which have come that will help it. Now, so if you keep that on one side, the liquidity and the uncertainty that we are seeing in Europe and Britain versus the strong domestic cues that we are seeing in India, where is the balance today, and could that balance change potentially in coming weeks?
See, one thing is very sure, that if the market, the global markets catch a cold, we'll also catch a cold. So there is...
as we already saw, yeah.
And contagion comes in through financial flows. So even the real economy might not be that linked in. We are not that big an exporter that we start sneezing if the world economy catches a cold. But it does impact us, and the financial flows impact us. So we can't say that we are isolated and we are an island. Secondly, we are in a sweet spot, what Brinda ma'am just said. But having said that, what we need is the reform process to go ahead. What has boosted the markets is the pay commission announcement. 100,000 crores comes in. That's nearly a 0.5% of the GDP kind of a stimulus coming into the economy. And if the monsoon is good after two bad monsoons, the rural economy starts recovering by October, November, and the credit also will start coming in. So out of the four pillars of the economy, exports are weak, private capex is weak, private investments. Private consumption is strong. Hopefully it will accelerate with good monsoon and pay commission. And government expenditure is strong. So these two are running, the other two are limping. That's the condition of the markets. Our markets undervalued? No, at 18 times for forward earnings, 1 year forward, they are fairly valued. But people will pay for the domestic consumption stories. We are seeing those sectors benefiting right now. The IT is suffering because we don't know how much will be the impact from Europe of this Brexit and if there's other domino effects. I think those remain. And what Anindya said, I think China remains a very big factor, because if China depreciates, all others have to depreciate in consonance.
Right. So let's pick up on the structural reforms, and let me begin with you. So what are the one or two areas? I know we're going to talk about GST, which is pending parliamentary, pending entry into parliament and therefore discussion. What else remains?
I think GST is more or less a given at this point of time. What we need to see is manufacturing. There are a lot of announcements that have been made, including a lot of announcements on FDI, but we need to see money actually come in. We need to see companies setting up a capacity on the ground. So that is yet to happen. And of course, on the agriculture front, we can't take it for granted. Already look at where the pulses prices are going, even though monsoons are supposed to be good. So we need to keep a close watch on that so that inflation remains under control. That's the most important factor. But I would say more than these, the bigger concerns are, what is the future of globalization? What is the future of free trade? And what is the future of migration? I think these are the issues that will really impact the way trade goes on globally, because trade is what drives growth. So if trade is going to shrink, then growth will shrink, and if global growth shrinks, then obviously India's growth will also be impacted.
And are there long-term cues that you're looking out for, which either concern you or not?
From Brexit, I think...
or in general, I mean anything, broadly in general, let's say the next 6 months, what are the things that you're looking for on your dashboard which make you either be concerned or maybe be optimistic?
As far as the external factors goes, one is top of the mind is China. And second would be how would the impact play out in Europe. Though I don't believe that there will be a domino impact in Europe as of now, but we have to watch out for three factors. One is the Spanish political scenario, two, the Italian banking crisis, and three, the French elections, which is in April of 2017. Because those can, one of them can, let's say a combination of them can upset the apple cart.
Right.
And domestically, apart from the GST and the reforms which are ongoing, two more areas which needs focus. One is the judicial reform. The two is the land reform. These are two important things which should also happen.
Okay. Ajay, let me come back to you. So if you were to look ahead now, what are one is the structural reform that you spoke of, which you think are most important. And in some ways, if we were to forget this whole episode of the last 1 week as a temporary shock, how do we get back to business? And as all of you have been saying, not let this cloud our judgment.
Yeah, I think a good thing is government came out with very accelerated reforms and announcements. So that pace should be kept on. Good things like DBT and the road sector accelerating 28 kilometers per day being made. I think those are extremely good factors. They're able to target subsidies and make the buck count wherever the government is spending. We have to enhance the spending because private spending will not come so fast. So twin drivers of this economy are government expenditure top down and second is private consumption expenditure. Both you have given stimulus. Now what we could wish for is another rate cut. I think if that would come in, because see, you've had a good monsoon, you've seen the pay commission being announced.
At the beginning of a good monsoon.
Yeah. Oh, but I have faith in the IMD, their forecasts. Okay. So looks like it should be okay, and with the La Nina setting in, it is looking fairly. But it's a good point you make. The market is over optimistic. Market has discounted that GST is passed. Market has discounted a good monsoon. Either of these legs don't come in, you could have a sharp correction.
Right, and the last point, very quickly before we close, the point that Brinda made about, are we prepared for an era or a world which maybe not see the same level of globalization or almost a reverse globalization from what we've been seeing all this while?
See, we aren't, because we need lot of employment. So, and we are a very domestic consumption economy, a reverse of China. You can say mirror image. China is manufacturing for the world and poor domestic consumption. Ours is the reverse. So we want to create jobs. Now that much of consumption is not possible domestically. China has too much manufacturing to allow us that space. So I think it's going to be a little bit grim unless we find our own model. Is it a service-based model? Now, textile, you have announced what are the 3 big employers in the country: agriculture, textile, construction. So, Mr. Gadkari is doing a great job on construction. We need to hire more people into that. Textile will generate a lot of jobs, and then you have to really get in a lot of manufacturing jobs. But where will those products get consumed remains a question.
Well, thank you all. For completely run out of time. That's all we have time for on this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.